Wondered how traders make around $1,000 by trading a $100 account, or how they lose their account in a single trade? Well, leverage is the key to that. And in this video, I will explain to you what is leverage and how to use it. So before we move forward, make sure you subscribe to this channel and don't forget to hit the notification bell. Leverage is nothing but the money that a trader borrows from his broker to increase his profit potential. So let us try to understand this with the help of an example. Let us consider you funded your trading account with $1,000 and your broker provides you no leverage. So you have to trade with leverage of 1:1. This means that with a $1,000 account, you can buy or sell only 1,000 units of any currency pair. Now let's say that you bought 1,000 units in USD JPY. That means you used a lot size of 0.01. If you don't know what lot size is, I have added a video for that on my channel. You can check it out. Moving forward, let's consider you bought 1,000 units in USD JPY at the price 110.000, and then the price moved to 111.000. This means that the price moved 100 pips. This means that you had a profit of $10, that is 1% of your account. Now let us consider that you had the leverage of 1:10. This means that your broker allows you to use 10 times of your account. So your broker lets you control a $10,000 account with an account of only $1,000. So you now bought 10,000 units in USD JPY at 110.000, and then the price moved to 111.000. This is a movement of 100 pips. So now with leverage of 1:10, you made a profit of $100. This is 10% of your account. So in simple terms, leverage means borrowing from your broker. So for the $1,000 account, the leverage of 1:10 gives you 10 times more money, that is $10,000, and allows you to buy and sell 10,000 units of any currency. So if your leverage is 1:100, it gives you 100 times more money. That is 100 times of $1,000 is $100,000. So it allows you to buy or sell 100,000 units of any currency, or use a lot size of maximum 1.0. Now you may be wondering, why does your broker let you borrow the money and how can it benefit the broker? Well, there is a very simple answer to it. Your broker earns money when you trade more, and therefore your broker wants you to trade more. Plus, the broker keeps your initial deposit aside, and as soon as your trading account is in loss, nearing your initial account balance, all of your trades are closed. For example, let us say that you had a leverage of 1:100 on your $1,000 account, and you entered a buy trade on USD JPY at 110.000 with a lot size of 1.0, that is, you bought around 100,000 units, and then the price moved to 109.000. This means that you had a loss of 100 pips. So now as your account was in loss of $1,000, your account will get flushed. That is, all your trades will be closed with a loss of $1,000, making you lose 100% of your account on a single trade. You can clearly see leverage is a double-edged sword. That is, it can double your account in a trade, but it can also make you lose your account in a single trade. So always choose proper leverage while trading. What is the perfect leverage, or which leverage you should use? I personally use the leverage of 1:50 for my big size accounts and 1:250 for my small size or challenge accounts. Professionals mostly use the leverage of 1:10 to 1:50 as their account size is big to let them use that leverage. For someone who is new to Forex and wants to try trading real account with small investments as low as $50, he can use a leverage of 1:100. Because with the account size of $50, you cannot use the leverage of 1:10. You won't even be allowed to open a trade with that leverage. So for accounts from $50 to $5,000, the leverage of 1:100 is appropriate. For accounts from $5,000 to $10,000 or more, you can use the leverage of 1:50. Just make sure you use a stop loss and don't risk more than 3 to 5% on a single trade. That's all for this video. Thank you.